U.S. consumer confidence jumped to a two-year high in July. This as inflationary pressure eased. The conference board said that the confidence index rose to 117 in July from about 110 in June. Home prices also stayed high in May. Before the seasonal adjustments, prices rose in all 20 major U.S. cities measured by the Case-Shiller Home Index in May, and that is the third month in a row. The reason? Low inventory, helping keep prices higher. All this news will be factored into, of course, the Fed's rate decision coming up in less than 24 hours. They are expected to lift rates to a two-decade high. And for more on markets and reaction, Karina Mitchell has more from the floor of the NYSE.
It was another big day for earnings, starting with General Motors that reported before the bell. EPS came in at $1.91. Adjusted revenue topped $44 billion. The estimate was for $42 billion, so a nice beat there, largely helped by U.S. sales and, of course, those popular truck models. It raised guidance for the second time this year, but did say cost-cutting measures would run into next year and would total $3 billion versus $2 billion. Now, the big black spot was EV production because they haven't ramped up as much as they would have liked. CEO Mary Barra said that was because of some supplier issues. They've only produced 50,000 units in the first half of this year. That was enough to send the stock lower by 3% by the close. Now, other big earnings today from tech giants Microsoft and Alphabet. Let's start with Alphabet. They delivered a beat. Earnings per share came in at $1.44 versus $1.34 expected. Revenue also was a big beat, $74.6 billion versus $72 estimated. That's a 7% increase, and it was largely driven by cloud revenue, which was up 28%. It's also doing very well with its YouTube views. That went up to 7.6 billion. The estimate was for 7.4 billion. And of course, very invested in their AI chatbot Bard as well. Now, Microsoft also reporting their earnings came in at $2.69 versus $2.55. A beat, and revenue came in 56.1 billion versus 55.4 billion. Also a slight beat, but it will close fiscal 23 down with revenue growth below 10%. That's the first time that's happened since 2017. It was a good day in the U.S. The Dow edging out another win, 12th straight day of gains, up by a fraction. NASDAQ solid 0.6%. S&P up by 0.2%. Want to take a quick look ahead to what we will see in the Wednesday session here in the U.S. More earnings on deck, Meta reporting along with Coca-Cola and Boeing, and of course that crucial Fed decision everyone's awaiting. Many people believe we will see an 11th rate hike. Karina Mitchell, CGTN, New York.
As mentioned, the Fed's decision is meeting today, decision tomorrow. We're joined now by Anthony Chan, former chief economist, J.P. Morgan Chase. Good to see you, my friend. I'm starting to get the feeling that the stock market just doesn't care about the Fed, because if you look at the way they've reacted to the past couple of meetings, the Fed has talked tough, and then the markets, I guess they don't feel well for a day or two, and then it's off to the races, and they've been just rallying almost every single time the Fed has their meeting. If you look at the charts, they seem to have essentially been ignoring all of the Fed's warnings when it comes to inflation. What's going on?
Well, I think they realize that the Federal Reserve is getting closer and closer to the end point, and that is, of course, very good news for the equity market, given the fact that inflation has already come down from over 9% on the CPI down to about 3%. So we are making progress, and the progress means a little bit of excitement for the equity market.
So all systems go in terms of investors, but when you say near the end of hiking, but not necessarily that they're going to cut rates, because I suspect that some people think that they're going to start cutting rates sometime, either the end of this year or next year.
I think it appears to me that they're not going to cut rates this year, that they will, in fact, consider it next year, but they're not in a rush. And the reason they're not in a rush is that their growth target on inflation is 2%. And so when you look at the inflation rate, it is above 2%. And if you look at it, taking out those very volatile components like energy or food, it is double that. So in that kind of an environment, they're not going to be in a rush to cut. But given the fact that inflation pressures are coming down, that means that current policy rates are even more restrictive. So they don't really have to raise rates all that much. That is, as inflation is coming down for a given level of monetary policy, it is more effective, and therefore the the equity market is pretty happy with that.
I mean, we're at a point now where you've had so many rate hikes and we're around 5%. What's the point of another 25 or even 50 basis points? I mean, it's not having the intended consequences when it comes to slowing down, say, consumer confidence or consumer spending. I mean, I understand the inflation aspect of it. That's already cooled off. So if it's working on inflation, why keep raising rates?
That's a great question, Phil. And the reason for that is pretty straightforward. And that is that what you're really worried about is inflation expectations. The minute they give the impression they're going to lower rates, they're afraid those expectations will get out of control.
If they raise their rates and then they announce something perhaps a little bit more dovish, meaning they're going to kind of look at the data, they're going to wait and see, and then we get some soft inflation numbers, which industries in the economy stand to benefit, being that the Fed doesn't necessarily lower rates, but just doesn't raise it anymore?
It's clear that it's going to be housing. And the reason for that is that right now the spread between mortgage rates and the underlying benchmark, the 10-year Treasury rate, is very, very wide. So if they're not going to raise rates, that spread can actually narrow.
If you're the Fed and you see this optimism out there, I was talking to a friend of mine, I was thinking to myself, everything that you see is exactly what the Fed doesn't want, right? We've got people working, we've got people with seemingly disposable income, you have consumer confidence near an all-time high. The Fed wants to see the opposite of all this. They want to see home prices drop. They want to see rents drop. They want to see people spend less. They want to see the unemployment rate to be actually higher, not lower. Can the Fed actually orchestrate the way people feel by simply raising or lowering rates? I feel like it's outside of their ability or power to control how people feel when it comes to the economy.
Well, Phil, there's a funny thing that's happening here. We know we lost a lot of people during the pandemic. The labor force collapsed, but the labor force now is even higher than it was before. So as the Federal Reserve continues to play this waiting game, guess what's happening, Phil? We're seeing more people entering the labor force. You can make the argument, and I'm doing some research on this topic right now as we speak, you may see that maybe more immigration is adding to supply. And as that happens, if the Federal Reserve just holds on, keeps raising rates marginally, or at least not lowering them, if you start to see more supply of labor, eventually these wage pressures go away. So they don't really have to really hit the economy too much harder with a hammer, a light touch with a small hammer, and they will get the job done. And so far, we have every indication that they're making progress.
Very interesting where we are today versus where we were, say, 6 to 9 months ago, how different it is. Anthony Chan, good to see you, my friend. Thank you.
My pleasure.